What's up guys, welcome back to InvestingPH. Now for the past months, I've been constantly buying these three stocks, DNL, Megaworld, and LTG, which I've been getting a lot of comments asking why I'm still buying these stocks, especially LTG. If you aren't aware, this company has had its fair share of negative sentiment because of the taxes imposed on tobacco products, which is set to increase 4% annually after 2023, and even for heated tobacco products, which is set at 5% per annum, starting 2024. I discussed this in my last portfolio update as to why I'm not at all concerned about my investment in LTG, so I'll just tackle this a bit. Now, this company is so far the largest contributor to my dividends. This year alone, it accounts for 20% of the payments I've received. This is also because it's the second largest holding in my portfolio. It takes up 9%. So the reason I'm not concerned about this is first, tobacco isn't the only business this company has. They have banking, alcohol, real estate, milling, and a lot more. If you look at the breakdown of their earnings, half of the year, tobacco accounts for 45% of their earnings. The second largest is their banking, 42%, and the remaining 13% is from their distilled spirits, beverage, property, milling, etc. So, 55% comes from other sources. So although there is an increase of 4% in the taxes imposed on their tobacco business, their other businesses can cope up with it. And if you look at their earnings, they are growing. And this isn't because of their tobacco business. And as I said in my portfolio update, do you see this company being obsolete 5 or 10 years from now? No, and for the price I paid for the company in relation to the dividends I get, I can get back the money I invested in less than 7 years. Even if they decrease their dividends a bit, I'd still get it back in the same time frame, especially if I compound the dividends I got and reinvest it back to my portfolio. So what is my strategy in this company? Well, I'd still hold it, buy more of it if I have extra cash, and I just invest the amount I'm comfortable with. That's it. The company's doing fine, debts are managed well, and they're growing their other businesses, as we can see in their capital expenditure. In 2022, from the 9.87 billion budget, 5.69 billion went to PNB and 1.30 billion to Asia Brewery on plant improvements, 763 million on Tanduay, and they also invested 2.1 billion on a joint venture with Ayala Land for the 35-hectare Park Link projects. So for the future of my investments here, I'm sure I'd be getting more of my money's worth. Next, let's talk about DNL, which right now has climbed to the third largest in my portfolio. It takes up 8%. The company's stock price have plummeted from last year's high of 8.5 down to 6.4. I've talked about DNL a lot of times in my videos and why I love the company. Their business is divided into food ingredients, oleochemicals, and other specialty products. These are biodiesels, resins, and powder coatings. The third is specialty plastics, and last is consumer products, from aerosols and non-aerosol products for home care, personal care, and maintenance chemicals. The company started way back 1963, and if you look at their long-standing customers, the longest is Boysen, which I'm sure most of us know, and we can see here a lot of large companies, Nestle, URC, Monday Nissin, all the large food companies KFC, Jollibee, McDo, Shakey's, Krispy Kreme, etc., and also 3M and Petron. With this alone, we can see the vastness of the market captured by this company. And it shows, even with the problems it has faced from the recent years, such as the China trade conflict and the pandemic, their revenue, although had been affected quite a bit, have now reached record highs. For earnings, they have now recovered to their pre-pandemic level. As to how this company is handling its debt-to-equity ratio is only 68.2%, or you can say for every 1 peso of equity, has 0.68 pesos of debt, which is very low. This means the company is easily handling its debts well, and you can see 2021 onwards, their debts have climbed. Well, we can relate this to their spending, which has increased exponentially because of their Batangas plant construction. So for 2023, it is expected to go down as they have already finished and have started the operations of their plant. So just imagine, their debts are well managed even while building of this new plant is taking place. With this completed, we can expect the company's business will further grow, as the plant is instrumental in DNL's goal of putting the Philippines on the map as a quality manufacturing hub for sustainable, natural, and organic products. And of course, not only is the company strong business and financially, their dividends are good as well. With the stock price dropping, their yield now sits at 4.7%. This is with a 61% payout ratio, so their dividends are well covered by their earnings. As dividends are connected to the earning power of the company, they've grown over the years. Although because of the pandemic it dropped, but as their earnings have now surpassed pre-pandemic level, their dividends as well have recovered. Now before we go on, if you're curious as to where I'm getting all these data, graphs I'm showing, this is from Simply Wall Street. I know you hear this in every video I make, but this platform is worth a mention. You may think of me as biased because I earn if you subscribe to my link, which by the way will give you a 40% discount. This is only given to the first 100 subscribers, so better grab the opportunity. But if you just want to try it out first, they have a 14-day free trial and a forever free basic plan. Anyway, before I even advertise this platform in my channel, I was already a user of Simply Wall Street. That's why I'm sharing it with you guys, as this helped me a lot in my investing journey. As I always say, I want an investing strategy that is for a lazy person, and this platform makes it more easier for me to get the data I need to analyze a company. With it being easy, I can maintain the strategy I'm using, because back then I needed to jump from platform to platform. Now, it's all in one side. And that's not all. They also have a portfolio tracker that lets you assess the health of your portfolio. I love how they give you detailed information about the returns of each stock, from capital gains and the dividends you got over the years you've held the stock. Although the only drawback to it is you can't put in the 10% tax imposed on us every time you get a dividend, but that's easily done by just taking off 10% of the total dividends the platform computed, which by the way is precisely the same as to my own stock portfolio Excel sheet, which I manually input every month. And if you don't have the time to check the news of each company you hold, well, this also updates you whenever the companies in your watch list release their earnings, when insiders are buying, dividends payout, and when the company falls below your computed buy price. Speaking of that, if you don't know how to compute it, they also have it for you, both analyst consensus or discounted cash flow. For me, whenever I use this function, I always put in a margin of safety. This means I cut off 20 or 30% off from their computation, and of course, I still compare it to my own computation. But if you don't know how to compute it, this is a good start for you. So try this platform out now. Thank you, and back to the video. For Megaworld, I've continued to invest in this company even after its massive price drop. It's nowhere near its pre-pandemic price, which was above 6 pesos per share. Now, it's stagnant in 2 pesos. My holdings here is actually one of my biggest losers. But even though it's like that, I've added some shares every now and then, because the company is doing fine. Their earnings are almost back to its pre-pandemic level. And as to how our economy right now, almost, hotels, real estate have gone back to normal, so I can assume they will be back to positive growth the coming years. And even though the real estate market was hit hard, they maintained their debt levels. Debt to equity is only 39.3%. And what I like about Megaworld, they are also growing their dividends. Only during the pandemic their dividends decreased, as dividends are connected to their earnings. But now, their dividends have recovered well. This year, they have reported higher dividends compared to 2022, which is almost close to their pre-pandemic payout. So I can assume with how Megaworld is doing now, their dividends in the next years would definitely breach their pre-pandemic yield. And just by looking at the company's valuations today, it is very cheap. Price to earnings is only 4, price to book is 0.3. With this two alone, you can see the company is really undervalued. I know the market sentiment in the real estate sector isn't good, but just look at how cheap its valuation is, and the financials of this company are strong, and Megaworld's real estate business are in prime locations, and for expansion, they still have 4,549 hectares of developable land, which is sufficient for the next 15 to 20 years of development. So with well-handled debt, stable earnings, and the potential to grow more in the years to come, this is the reason I'm still investing more in this company. Though the Philippine market's recovery is still unclear, for me predicting when it will come is a waste of my time. What I just do is to invest in stable companies and reinvest all the dividends I receive and wait. I have time on my hand, and while waiting, I'm still growing in the process. So with that said, I hope you got something from this video, and if you did and still haven't clicked the like button, be sure to do so before leaving. Thank you, and see you in the next video.